It was a Tuesday in November of 2024 when the letter landed in the Scottsdale mailbox. Frank Maddox was 74 years old. He had just poured his second cup of coffee. He had just turned on the television to a morning show about weather. The mail truck had already come and gone. His golden retriever was asleep by his slippers. Linda, his wife of 48 years, was still at the kitchen table writing in her prayer journal, the same journal she has kept since 1987. Frank picked up the envelope. It had a return address he did not recognize. Inside was a single page from the Internal Revenue Service. The letter said his required minimum distribution for the year was $112,000. The letter said it had to be taken out of his traditional IRA before December 31st. The letter said if he did not take it out, he would owe a penalty of 25% on top of the tax. 25% on top of the tax. Frank set the letter down on the counter. Then he called his daughter in Seattle. Sandra picked up on the second ring. She works as a school counselor and she always answers her phone. Dad said one sentence. He said, "Baby, I think the government just took my retirement." And he was not wrong. Now, before I tell you the rest of Frank's story, I need you to do one thing for me. If this hits you in the gut, if you have a parent over 65, or if you have a retirement account yourself, hit like right now. Because this story needs to land in front of more families before the next letter shows up in their mailbox. Now let me take you inside what is really happening. Frank Maddox worked for 36 years as a structural engineer for Boeing. He started in 1983. He finished in 2019. He never made a fortune. He made a salary. He made about $87,000 a year at the end. But he saved almost every dollar he could. He rolled his 401k into a traditional IRA when he retired. He also had a small pension from Boeing. He also had Social Security. When you add it all up, his traditional IRA sits at $1,900,000. He has a smaller IRA from his wife at about $212,000. Combined, the couple has just over $2,100,000 in retirement accounts. None of it is in a Roth. Every dollar is pre-tax money that has never been taxed. For 40 years, Frank did what every retirement teacher told him to do. Save, save, save. Put it in your 401k. Get the tax break now. Let it grow. Pay the tax later. And that last line is the one that broke him. Pay the tax later. Nobody told Frank what later really looked like. Nobody told Frank about the rule called RMD, Required Minimum Distribution. Let me say that again in plain English. A required minimum distribution is a rule the IRS makes you follow after a certain age. It says you must pull a certain amount of money out of your traditional IRA every single year. You do not get to choose, you do not get to skip it. If you skip it, the IRS charges you a penalty of 25% of the amount you were supposed to take. Yes, 25% on top of the tax you already owe. In some cases, the penalty can drop to 10% if you fix the mistake fast. But most retirees never know they missed it until the letter arrives. And by then, the 25% is already on the table. After the Secure Act 2.0 passed in late 2022, the age for required minimum distributions moved to 73. So at 73, the IRS knocks on your door for the first time, and they knock every year after that until you die. Let me walk you through the live math. This is real math. This is what is happening to Frank right now. Frank has $2,100,000 in traditional IRAs as of December 31st, 2023. The IRS table says at age 74, the divisor is 25.5. That means his required minimum distribution for 2024 is about $82,000. For his wife, Linda, age 71, she is not yet 73. She still has 2 years before her RMD starts. But Frank is not just taking $82,000. He is also taking the rest of his living expenses from the account. So when the smoke clears, he pulled $112,000 out of that IRA in 2024. He had to. Their mortgage is paid off. Their monthly bills are about $6,400. He covers health premiums, groceries, and some help for his wife who has early arthritis. He is not living large. They live modestly. But $112,000 came out in cash. Now the tax bomb lands. Frank lives in Arizona. Arizona has a flat state income tax of 2.5%. His federal tax bracket is 24% because his total income pushes him into the fourth biggest federal bracket. The Social Security taxation rules, also called the Social Security clawback, mean up to 85% of his Social Security benefit now becomes taxable too. Let me do the live math out loud for you. He pulls $112,000 from the IRA. 85% of his Social Security, which is about $28,000, becomes taxable. Add in his Boeing pension of $19,000 a year. Add in a small interest payment from a savings account at the credit union. His total taxable income jumps to $164,000. Federal tax on that, at the rates that apply to a married couple filing together in 2024, is roughly $34,800. Arizona state tax adds about $4,100 more. Medicare premiums go up because his income pushed him above the IRMAA threshold. That adds $2,900 more to his Medicare Part B and Part D premiums for the next year. The Social Security clawback itself cost him roughly $6,100 in extra federal tax because his Social Security was pushed into taxable territory. When you add it all up, the total tax cost for 1 year was about $47,900. Out of $112,000 pulled, $47,900 went straight to taxes. That means Frank keeps roughly $64,100 for the year. And this happens every single year from 73 until he dies. But it gets worse. Because Frank has $2,100,000 in the account, the IRS table forces him to take larger and larger withdrawals every year. By age 80, his required minimum distribution alone will be about $119,000. By age 85, it will be $158,000. By age 90, it will be over $200,000 a year, even if he does not need the money. And that growth in forced withdrawals is what the IRS calls bracket creep. Let me explain bracket creep in plain English. Bracket creep is what happens when your income slowly rises each year because the IRS forces you to take more and more out. Each year, your income goes up. Each year, you may slip into a higher tax bracket. A higher tax bracket means a bigger percentage of every new dollar goes to the government. So the more you're forced to take out, the more of every new dollar disappears in tax. The trap grows on itself. It does not stay flat. It gets worse every year. Frank thought his money was safe. He thought because he had $2 million in the bank, he would retire like his father did, comfortable and quiet. He thought the $2 million was his, but the $2 million was never really his. Not all of it. Not when the IRS owns a slice of every dollar in that account. Not when the IRS forces him to take money out. Not when the IRS chooses how much and when. Not when bracket creep and state tax and Social Security taxation and Medicare surcharges all stack on top of each other. Over the rest of his life, if Frank lives to 90, he will pull roughly $3,100,000 out of his traditional IRA. Of that $3,100,000, about $1,200,000 will go straight to federal tax. About $160,000 will go to Arizona state tax. About $140,000 will go to Medicare premium surcharges. The rest, about $1,600,000, is what he actually keeps. Let me say that number again so it lands. Out of $3,100,000 that he pulls out, he keeps $1,600,000. About half of his retirement disappears into taxes, fees, surcharges, and the system. And this is the part nobody told him at work. At work, the 401k salesman said save more. The HR person said max it out. The financial magazine said you are on track. The retirement calculator online said $2 million is plenty. Nowhere on that calculator did it warn him that the IRS would come back for close to half of it. Now, I want to pause for a second and ask you something. Tell me your age in the comments. Tell me how much you have saved in your IRA or 401k, because the IRS does not care what the number is. The rule applies if you have $1 in a traditional IRA. The IRS will force you to take it out. The bigger the account, the bigger the problem. But even a $500,000 account can trigger bracket creep, Social Security clawback, and Medicare surcharges. Drop your numbers below. I read everyone. Let me explain the 3 hidden traps that sit on top of required minimum distributions. These 3 things are why this is the real story and not just an accounting problem. The first hidden trap is Social Security clawback. When your other income goes up, the IRS can tax up to 85% of your Social Security benefit. So every new dollar you pull from your IRA can trigger an extra tax on Social Security income you already receive. It feels like the IRS is taxing the same dollar twice. Frank is pulling $112,000 from the IRA. That pull pushes $30,000 of his wife's Social Security benefit into taxable territory. They did not earn that income. They are not choosing to take it. They are just being taxed on money the government already told them was theirs. The system stacks 2 taxes on one event. The second hidden trap is IRMAA. That stands for Income-Related Monthly Adjustment Amount. In plain English, IRMAA is a Medicare surcharge. If your income 2 years ago was high, Medicare raises your Part B and Part D premiums for the next year. So if Frank pulls a big RMD in 2024, his Medicare premium in 2026 goes up. He does not control either side of that deal. He pulls money once. He pays more for health insurance twice. For someone on a fixed income, that is a gut punch. For someone with a chronic illness, that surcharge can be thousands of dollars a year for the rest of their life. The third hidden trap is the inherited IRA bomb. If Frank dies and leaves his traditional IRA to Sandra, Sandra has to drain the entire account within 10 years. Most people have heard about the 10-year rule, but most people do not understand the trap inside it. If Sandra does not plan, she has to pull massive amounts out in year 10, and she gets crushed by the same tax Frank got crushed by. Worse, Sandra is still working. She is in her peak earning years, so her tax bracket is 32% or higher. That means the IRA Frank saved for 40 years gets taxed at Sandra's high working bracket, not Frank's retired bracket. This is the inheritance trap most families never see coming. Now let me talk about state differences because this matters. If you live in Florida, you have no state income tax. That helps a little. But you still owe federal tax, you still owe IRMAA surcharges, you still owe Social Security clawback. So Florida retirees think they are safe. They are not safe. They are just safer. If you live in Texas, same story. No state income tax, same federal trap, same Medicare surcharge trap, same Social Security clawback trap. If you live in California, your state income tax can hit 9.3% on high-income retirees, on top of federal. That is a combined hit of over 40% on every RMD dollar in some brackets. If you live in New York, the top state bracket for retirees can push close to 11%. Add federal, and you're looking at over 50% gone on the highest RMDs. If you live in Pennsylvania, the flat 3.07% helps, but federal bracket creep still does most of the damage. If you live in Illinois, the flat 4.95% makes it worse. If you live in Arizona like Frank, you get the 2.5% flat, but you still lose close to half of what you pull out when federal and IRMAA stack on top. The rule is federal. The pain is state by state. Tell me your state in the comments. I want to know where you live because the trap behaves differently in every state. Florida retirees, drop a palm tree emoji below. Arizona retirees, drop a cactus. New York retirees, send me your story. California retirees, tell me the highest bracket you have ever paid. Now let me show you what real families are doing to fight back. These are not tricks. These are legal moves inside the tax code. They have been used by retirees for decades. They are not loopholes. They are not risky. They are not schemes. They are written into the Internal Revenue Code. Most retirees just never hear about them. The first strategy is the Roth conversion ladder. A Roth conversion is when you move money from a traditional IRA into a Roth IRA. The money gets taxed in the year you move it, but once it is inside the Roth, it grows tax-free, and the IRS cannot force you to take it out during your lifetime. There are no required minimum distributions on a Roth IRA for the original owner. That means if Frank had converted $500,000 of his traditional IRA into a Roth IRA between ages 66 and 72, he would have paid tax on it while his tax bracket was lower. Then the rest of his IRA would be smaller. Then his required minimum distribution would be smaller. Then his bracket creep would be smaller. Then his Social Security clawback would be smaller. Then his IRMAA surcharge would be smaller. Every single trap gets smaller. Most retirees wait too long. They wait until 72. By then, their IRA is too big. The conversion crams them into the 32% bracket. They cannot move enough without crushing their tax bill. The smartest retirees start the Roth conversion ladder at age 60. They do small conversions every year. They keep their tax bracket flat. They reduce the future bomb. They do it before the RMD rule engages. The second strategy is the qualified charitable distribution. A QCD is when you are 70 and a half or older and you send money straight from your IRA to a charity. The money never lands in your bank account, so it never shows up as income, so it never bumps your tax bracket, so it never triggers Social Security clawback, so it never raises your IRMAA premium. It is the cleanest tax move in retirement. If Frank donates $20,000 a year to his church through a QCD, he avoids $20,000 of taxable income. He avoids the bracket creep. He avoids the Social Security clawback. He avoids the IRMAA surcharge, and the charity still gets the money. This is the move most retirees never hear about because it is not sold on television. There are no banner ads for it. There are no infomercials for it. It just sits inside the tax code waiting for someone to use it. The third strategy is tax bracket targeting. That means you pull money out of your IRA on purpose in low-income years so you never get pushed into a higher bracket by surprise. Many retirees do this in the gap year between retirement and age 73. They retire at 65. They have 2 years before Social Security kicks in. They have 8 years before RMDs kick in. In that gap, they pull money from the IRA on purpose, fill up the 12% bracket, then stop. They pay 12% now instead of paying 32% later when the RMD bomb hits. That gap window is the most valuable tax planning window in retirement. Most retirees waste it. The fourth strategy is asset location. That means you put your growth investments in your Roth and your bond income in your traditional IRA because the bonds throw off interest that counts as ordinary income. You want to keep that inside the traditional IRA where it stacks with the RMD anyway. The growth investments, the ones that throw off long-term capital gains, you put those in the Roth so they grow tax-free and you never pay RMDs on them. The fifth strategy is kind of sneaky but powerful. It is the asset spend down plan. Some retirees intentionally invest their traditional IRA in a balanced portfolio that pays them a steady income stream. They live off that income stream. They let their Roth sit untouched. Over time, the traditional IRA slowly drains. The Roth keeps growing. By the time they die, the Roth is bigger. The traditional IRA is small. The RMDs are smaller. The inheritance tax bomb is smaller. This is the kind of plan a good CFP, a fiduciary fee-only advisor, can build with you. Now let me show you the danger of waiting. If Frank waits until 74, his first RMD hits. His tax bracket jumps 24 to 32%. His IRMAA surcharge kicks in. His Social Security clawback maxes out. He loses close to 50 cents on every new dollar. If Frank waits until 75, his second RMD hits. His required amount grows because the IRS table divisor shrinks every year. His tax bill grows. His IRMAA surcharge grows. His clawback grows. If Frank waits until 80, his required minimum distribution alone is bigger than the paycheck he earned in his last year at Boeing. He pulls more money than he ever spent, just to give half of it back. If Frank dies at 85 without any planning, Sandra inherits $2,500,000 in traditional IRAs. She must drain it within 10 years. She tries to take $250 a year. At her tax bracket, she loses $80,000 a year in tax. The IRS gets $800,000 from an account Frank built over 40 years. That is the trap. Now let me give you the action plan. The moves you can do tonight, not next year, tonight. Step 1. Pull up your most recent IRA statement. Write down the total balance. Write down the date. Write down your age today. That is your baseline. Step 2. Call a CPA or a fiduciary financial advisor within the next 14 days. Not a salesperson. A fiduciary. Someone who is paid to act in your interest, not to sell you a product. Ask them to run your RMD projection for the next 20 years. Ask them what bracket you will be in at 73, at 75, at 80, at 85. Step 3. Start a Roth conversion plan before you turn 72 if you are under 72. Move money slowly. Fill the 12% bracket. Pause. Resume next year. Step 4. If you are 70 and a half or older, set up a qualified charitable distribution with your church or your favorite 501c3 charity. Do not let that money land in your bank account first. Send it directly from the IRA to the charity. Step 5. Stack your moves between now and age 72. The window is your last tax discount before the IRS comes knocking. Step 6. Call your adult children. Tell them what the inherited 10-year rule means. Tell them to plan around it. If your daughter or son does not understand RMDs, they will inherit a tax bomb. The bomb does not just hurt you, it hurts them. Step 7. Document everything. Save this video. Send it to one family member tonight. Save the link in a note on your phone. Send it to your CPA. Use it. Now let me close this with the truth. Frank Maddox did everything right. He worked for 36 years. He saved his money. He paid his taxes. He raised a daughter he is proud of. He lives in a paid-off house in Scottsdale. He did not gamble. He did not steal. He did not cheat. He followed every rule the system taught him, and then the system took almost half of his retirement. That is not a market crash. That is not a divorce. That is not a failed business. That is the government rulebook working exactly the way it was designed. The IRS is not the villain in this story. The IRS is just doing what the law says. The real villain is the silence. The silence from the 401k salesman, the silence from the HR department, the silence from the magazine article, the silence from the financial influencer with the sponsored ad. The silence is what costs families like the Maddox family hundreds of thousands of dollars. You do not have to live in that silence, not anymore, not after this video. Frank called Sandra that Tuesday after the IRS letter. Sandra flew to Scottsdale the next weekend. The two of them sat at the kitchen table with Linda and talked about the Roth conversion. The four of them sat at that same table the next month with a fiduciary advisor. They built a 7-year Roth conversion plan. They set up a qualified charitable distribution to the local food bank. They are now filling the 12% bracket every year. They are lowering the future bomb. Frank told me last month that for the first time in 2 years, he slept through the night without worrying about the IRS letter in November. That is what the truth does when you act on it. If this story helped you, subscribe now. Hit the bell. Because in the next video, I am going to tear open another rule most retirees never hear about, the Social Security claiming age trap, the one where waiting 1 extra year or claiming 1 year too early can cost a retiree over $180,000 in lifetime benefits. You do not want to miss it. Drop your age and your state in the comments. Tell me how much is in your IRA. Tell me what your advisor told you about RMDs. Tell me if the silence has ever hurt your family.